Hello everyone, welcome to this video discussion under the income taxation and corporation. In this video, we are discussing about the item of gross income and its schemes, which are final income taxation, capital gains taxation, and regular income taxation. In gross income earned by taxpayers may be subject to any of the above schemes depending on the nature or type of income earned. Hence, gross income may be subject to final tax, capital gains tax, and regular tax. It is important to identify the type of taxpayers and income earned. First, let me discuss the gross income subject to final tax. So in gross income tax scheme, the final tax is also a passive income. Let us define what is final tax. In final income taxation is characterized by final taxes wherein full taxes are withheld net of taxes. So the payer is the one required by law to remit the tax to the government. So basically, when we are talking the final tax, it means that the payee or the one who received income or the taxpayer does not file the income tax return for that final tax or passive income. In final income taxation or FIT, there are features of it. These are the final tax, tax withholding at source, territorial impositions, and imposed on certain passive income and persons not engaged in business in the Philippines. The final tax means only withheld can be paid or no other income or taxes should be paid by the taxpayee. Next is tax withholding at source. It is withheld by the payer. He or she can be paid to the government. So before the income was given to the taxpayer, there is no final income tax subjected because it is withheld by the source already. The territorial impositions, meaning that the passive income should be earned in the Philippines and it is the only can subject to final tax. So if the income does not earned in the Philippines, definitely it will go either to regular tax or it may be exempted. And the fourth one is the imposed on certain passive income and persons not engaged in business in the Philippines. So in certain passive income or passive income, it refers to income or earned with very minimal involvement from the taxpayer and are generally irregular in timing and amount. And then for non-resident persons not engaged in business in the Philippines, it refers to NRA and ETB that have general final tax rate with 25% and non-resident foreign corporation that have general final tax rate with 30%.
Active income, also called as regular income, arises from transactions requiring a considerable degree of effort or undertaking from the taxpayer. It is the direct opposite of passive income. Examples: compensation income, salary, business income, professional income. Active income and passive income are two primary categories of earnings that are subject to different tax treatments, including final income taxation or FIT. Active income. Active income is an income earned from performing services such as wage, salaries, commissions, and tips. It requires active involvement in work or business activities. For taxation, active income is typically taxed at progressive rates based on the individual's total income for the year. The tax rates increase as income levels rise, with higher income earners generally paying higher tax rates on their active income. Passive income, income earned with very minimal or even without active involvement of the taxpayer in the earning process, hence the term passive. Examples: interest income from banks, dividends from domestic corporations, royalties. Also, passive income is generated from investments, rental properties, or business activities in which the individual is not materially involved. This type of income can include dividends, rental income, and capital gains. Passive income is often subject to different tax rules compared to active income. It may be taxed at lower rates or be eligible for specific tax deductions depending on the source of the passive income and relevant tax laws. When managing your finances and considering tax implications, it's important to differentiate between active and passive to ensure accurate tax reporting and compliance with tax regulations. So, I have an example of active income and passive income. Active income. Sarah is a marketing manager at a technology company. She earns a salary for her work and actively participates in the company's marketing campaigns, strategy development, and client interactions. Sarah's salary is considered active income because it is the result for her active involvement and effort in her job role. For the passive income examples, in contrast, Sarah also owns a rental property that generates rental income. She hired a property management company to handle tenant issues, maintenance, and rent collections. Sarah's rental income from the property is considered passive income because she is not actively involved in the day-to-day management of the property. The income is generated passively through the rental property investment. Sarah's salary as a marketing manager represents active income as it requires her active participation in her job's duties. On the other hand, the rental income from the properties is classified as passive income since it is earned with minimal active involvement on Sarah's part. Understanding the distinction between active and passive income is essential for the tax reporting and compliance in final income taxation or FIT. Passive income subject to final tax. Number 1. Interest or yield from local bank deposits or deposit substitutes. Number 2. Domestic dividends in general. Number 3. Dividend income from a real estate investment trust. Number 4. Share in the net income of a business partnership, taxable associations, joint ventures, joint accounts, or co-ownership.
And now, let's proceed to capital gain taxation. Capital gain taxation is imposed on the gain realized on the sale, exchange, and other disposition of certain capital asset. In other words, when you say capital gain taxation, it is a tax by an investor upon selling their assets based on the amount which asset appreciated during the time it was held. To understand more, when the stock share or any other taxable investment assets are sold, the capital gains or profits are referred to as having been realized. And now, let's talk about capital asset and ordinary asset. When we say capital asset, this is not used in business, trade, or profession. These are opposite of ordinary asset, which is the capital asset are significant piece of property such as homes, cars, investment, properties, stocks, bond, and even collectible or arts. And it's not intended for sale in the regular course of business operation. In other cases, a business disposes of capital assets if the business is growing and needed something better. For example, a business may sell one property and buy a larger one in a better location. While when we say regular asset, this is the asset used in business, trade, or profession such as inventory, supplies, or property, plant, and even equipment. So let us remember that when we say capital asset, this type of asset that you own or something you purchase for personal use, while the ordinary asset, these assets are used in trade or business profession. Then let's proceed to number 3. Not all disposition of capital asset will result to CGT, the capital gain taxation. Some disposition of capital asset are subject to regular income tax. Then CGT only applies the two types of capital asset, which is domestic stocks and real properties. When we say domestic stocks, this refers to the share of a company that is based in the investor home country. These stocks are traded on the country's local stocks exchange. The real property, this refers to the land and any permanent structures or improvement attached to the land, such as buildings, home, faces, and etc. The last but not the least, CGT employs the self-assessment method. That is, the taxpayer is required to file an income tax.
Regular income taxation is a tax imposed on individuals' income by the government. It is typically calculated based on various sources of income, such as wages, salaries, bonuses, rental incomes, and investment income. This tax is a key source of revenue for governments and is used to fund public services and programs. This is considered as general rule in income taxation. The following are subject to regular income taxation. Active income is an income generated from direct participation in a business or trade, where an individual is actively involved in earning money. It requires ongoing work to generate revenue. Here are some examples of active income, such as salary, wages, commissions, tips, and also consulting fees. Salaries, earnings from a job where an individual receives a fixed amount of money on a regular basis for their work. Wages, payments for hourly work or services rendered, typically in a structured work environment. Commissions, income earned based on the sales or performance achieved, often in sales or marketing roles. Tips, gratuities or additional payments received for services provided, common in industries like hospitality and food services. Consulting fees, income earned by the providing specialized advice or services to clients on a contractual basis. Other income which can either be. Here are some examples of that. First is real estate flipping, second rental income, and the third is real estate trading. The first is real estate flipping, buying properties with the intention of quickly renovating and selling them for a profit. The second is rental income, income earned from renting out properties, including residential and commercial real estate. And the third one is real estate trading, regularly buying and selling properties as a business activity to generate income. Other passive income not subject to final income tax. Here are some passive income and not subject to FIT or final income tax. The first one is qualified dividends. Dividends received from qualifying stocks that meet certain requirements set by the IRS. And the second one is municipal bond interest. Interest income earned from investing in municipal bonds issued by the state or local governments, which is typically exempt from federal income tax. And the last one is income from limited partnerships. Earning from limited partnerships where the individual is a passive investor and not actively involved in the business operations. Similar to capital gain tax or CGT, real income tax employs the self-assessment method. The first one is tax rates. The self-employment tax rates combine the Social Security tax and Medicare tax. And the second one is quarterly repayments. Self-employed individuals are typically required to make quarterly estimated tax payments to cover their self-employment tax obligations. And the third one is tax deduction. Self-employed individuals can deduct certain business expenses from the self-employment income to reduce their taxable income and overall tax liability.
Income tax on corporations. Under Section 2 of Revised Corporation Code, RA number 11232, which amended the Corporation Code BP 68. A corporation is defined as an artificial being created by operation of law, having a rights and successions and the powers, attributes, and properties expressly authorized by law or incident to its existence. As the terms corporations include the following entities. First is partnerships. No matter how created or organized, this refers to general partnerships, limited partnerships, and limited liability partnerships. The income generated by partnership is subject to taxation. Second, joint stock companies. These are companies whose capital is divided into shares of stocks and are authorized to issue transferable shares to the public. The income generated by joint stock companies is subject to taxation. 3. Joint accounts are syntax in participation. This refers to business arrangement where one person contributes capital while another person manages the business. The income generated from joint accounts is subject to taxation. Fourth, associations, organized or organizations formed for a specific purposes, such as social, cultural, or charitable activities. The income generated by associations is subject to taxation. 5. Insurance companies. These are companies engaged in the business of providing insurance coverage. The income generated by insurance companies is subject to taxation. 6 is one-person corporations included by the created law. This refers to corporations with a single stockholder who is a natural person, trust, or estate. The income generated by one-person corporations is subject to taxations. These entities are considered as corporations for income tax purposes and the subject to the relevant tax laws and regulations. The general professional partnerships refers to the partnerships formed by professionals such as doctors, lawyers, accountants, or engineers who provided professional services, and income generated by this partnership is subject to taxation. Joint ventures or consortia can be formed for two purposes: undertaking construction projects, when multiple entities come together to undertake a construction project. The joint venture or consortium form is considered as a corporation for income tax purposes. The income generated from the construction project is subject to taxation. Engaging in petroleum, coal, geothermal, and other energy operations, if entities form a joint ventures or consortium to engage in energy operations such as petroleum, coal, geothermal, or other energy-related activities, it is considered as corporation for income tax purposes. The income generated from these energy operations is subject to taxations. These provisions are outlined in Section 22B of the Tax Code.
Definition of terms. Partnerships. A partnership is one created when two or more persons contribute money, property, or industry to a common fund with the intention of dividing the profit among themselves. Article 1767 of the Civil Code. And the definition of partnership is a legal agreement that allows two or more people to share responsibility for a business. those partnerships share the ownership in profits, but they also share the work responsibility and potential losses. Another example of partnership, a form of partnership that arises where the partnership has been entered into for an undefined term. Partnership at will may be dissolved at any time by a partner serving notice on the other partners. General professional partnership. Partnership formed by person for a sole purpose of exercising their common profession, no part of the income of which is derived from engaging in any trade or business. And the example of general professional partnership is law firms, medical practices, and architectural firms often organize themselves as general partnership. Spouse and other members or family who want to run a business together also set up a general partnership. Joint venture, a commercial undertaking by two or more persons, differing from a partnership in that it relates to the deposition of a single lot of goods or the completion of a single project. Joint venture, a business agreement in which two or more parties agree to pool their resources for the purpose of accomplishing a specific task. Another example of joint venture, Ford and Toyota began working together in 2011 to develop hybrid trucks. Toyota brings the hybrid technology knowledge, while Ford brings its leadership in the American truck market. The perfect example of a joint venture created in access to expertise and intellectual property. Joint stock company constitute when a group of individuals acting jointly establish and operate a business enterprise under an artificial name when an invested capital divided into transferable shares, an elected board of director and other corporate characteristics, but operating without formal governmental authority. Another definition of joint stock company: a joint stock company is co-owned by its shareholders. Shareholders' stake depends on the number of stock owned by them. They are liable only the extent of shareholding. Also, stockholders can transfer their shares without any restriction. And we have another example of joint stock company. A joint stock company is a company that owned by multiple owners who have different numbers of holding of stock. In other words, all majority owners have a certain percentage of the company. Together, they own the company. Joint accounts constitute when one interests himself in the business of the other, contributing capital and sharing in the profits or losses in the proportion agreed upon. They are not subjected to any formality and may be privately contracted orally or in writing. Joint accounts where two or more parties share a single account, such as a bank or brokerage account. In this case, the law considered both parties to be equal owners, no matter who started the account or who contributes more money. Another example of joint account. Let's consider a married couple, Romeo and Juliet, who decide to open a joint bank account for managing their finance together. They discuss their financial goals and decide that having a joint account will be convenient for managing share expenses. Include all organizations which have substantially the silent features of a corporation to be taxable, such as I have a simple definition of association: a group of persons who share common interests of a common purpose and who are organized with varying degrees or formality. Compare corporation. The act of having contact or communication with or keeping company with another. Freedom of associations. And another example of association: any anytime people or things are connected, there are associations. For example, the National Basketball Association is an example of the business meaning of association: a formal organization or group that works together.
Classifications of corporations. There are two types of corporation. First is a domestic corporation. Domestic corporation is a corporation created and organized under the laws of the Philippines. Examples are San Miguel Corporation, Jollibee Food Corporation, and etc. So a domestic corporation is a business entity that is incorporated in the same country where it conducts its operations. For example, American companies like Apple, Google, and Walmart are considered domestic corporations in the United States because they are incorporated there and operate within the country. Another example of a domestic corporation is a Toyota Motor Corporation in Japan. It is incorporated in Japan and operates within the country, making it a domestic corporation there. The tax base of the domestic corporation refers to the amount of income or profits that are subject to taxations by the government of the country where the corporation is incorporated and operates. This typically includes the corporation's worldwide income, but specific rules may vary by country. Taxes are usually calculated based on this taxable income after deductions, exemptions, and credits are applied. The second type of corporation is a foreign corporation. Foreign corporation is a corporation created and organized under the foreign laws. It can either be a resident foreign corporation and a non-resident foreign corporation. A foreign corporation is a business entity that is incorporated in one country but operates and conducts business activities in another country. So this means that the company's headquarters are legal registrations and in a different country from where it primarily does business. Another example of a foreign corporation is Toyota Motor Corporation, a Japanese multinational automotive manufacturer. Toyota is considered a foreign corporation in countries outside of Japan because its headquarters or primary operations are based in Japan, making it a foreign entity in those locations. And also, a foreign corporation is a company that is incorporated in one country but conduct its business operations in another country. For example, if a corporation is incorporated in Japan but operates in the United States, it would be considered a foreign corporation in the US. Some examples of foreign corporations include Samsung Electronics in South Korea, Nestle in Switzerland, and BP in United Kingdom. The non-resident foreign corporation is a corporation has no permanent establishment in the Philippines, not regularly engaged in trade or business in the Philippines. So a non-resident foreign corporation is a company that is incorporated in a country other than the one in which it is conducting business activities. These corporations do not have a physical presence or significant operations in the country where they are considered non-residents. They may still engage in business activities in that country, but their legal status and tax obligations differ from those of domestic corporations. An example of a non-resident foreign corporation is Samsung Electronics, a South Korean multinational company. Samsung operates globally, including the United States, but since it is incorporated in South Korea, it is considered a non-resident foreign corporation in countries where it conducts business. The tax base of a non-resident foreign corporation typically includes income generated within a specific country, such as profits from business activities conducted there. This income can be derived from various sources, such as sales of goods or services, investments, or royalties. Non-resident foreign corporations are usually taxed on the income earned within the country where they operate, often subject to specific tax laws and regulations governing foreign entities. And a resident foreign corporation is a foreign corporation that is considered a tax resident in a country other than its home country. This means that a foreign corporation has substantial presence in the foreign country, such as having a permanent establishment, carrying out business activities, or meeting other criteria that qualify it as a tax resident. As a tax resident foreign corporation, the company is subject to tax laws and regulations of the foreign country in which it is considered a resident. This may include paying taxes on income earned within that country, complying with local tax reporting requirements, and being subject to other tax obligations imposed by the foreign jurisdiction. Overall, the concept of a resident foreign corporation helps ensure that foreign companies operating in a country are subject to the same tax rules and regulations as domestic companies, promoting fair competition and tax compliance. An example of a resident foreign corporation could be Nestlé, a Swiss multinational food and drink processing corporation. Nestlé has a significant presence in various countries around the world, including the United States, where it operates multiple subsidiaries, factories, and distribution centers. In the US, Nestlé is considered a resident foreign corporation because it conducts substantial business activities and generates income within the country, making it subject to U.S. tax laws and regulations as a foreign entity. The tax base of a resident foreign corporation is typically determined by the country in which it is considered a tax resident. The tax base refers to the amount of income or profits on which the corporation is required to pay taxes to the country's government. The tax base for a resident foreign corporation may include various types of income such as income generated from business activities conducted within the country, profits earned from sales of goods and services to customers in the country, rental income from properties located within the country, dividends, interest, or royalties sourced from the country, capital gains from the sale of assets located within the country. The specific rules and regulations governing the tax base of a resident foreign corporation can vary by country and may be subject to tax treaties, domestic tax laws, and international tax principles to prevent double taxation and ensure fair taxation of foreign entities operating within a country's borders. And that's the classification of corporation.
What is tax base? Tax base is the total value of all the assets, income, and economic activity that can be taxed by a taxing authority, where usually it is a government to sustain the country for infrastructure, for the growth of a country or state, as tax is the lifeblood of a state. Now, we have here the three types of corporations, and here we are able to know how to get the taxable income. What are those factors that we need to calculate in order for us to get the taxable income? First is the regular corporate income tax, or RCIT, which the gross income is less or minus by allowable deductions, which is the maximum allowable deductions is 40%. The second one is the MCIT, or the minimum corporate income tax, in which the gross income as contemplated in the tax code. Net sales or receipts, for example, gross sales or receipts less sales returns, discounts and allowances, less any cost of sales or cost of services. The third one is for non-resident foreign corporations, or NRFC. The tax base is the gross sales or receipts, which generally connotes sales or receipts less discounts, returns, and allowances. Now, let's proceed for the formula. The total gross sales or receipts less or minus the discussions or returns, and the total will be the net sales. And the net sales will less the cost of goods sold or cost of sales, and the total will be the gross income. And then the total of gross income will be less or minus to itemize deductions, or SD. Corporate taxpayers can avail themselves for the optional standard deduction or OSD computed at 40% of gross income. The optional standard deduction is in lieu of the itemized operating expenses. And after we less the gross income to itemized deductions or OSD, here we can come up with our taxable income. Note: we always need to remember that gross income excludes items which are subject to capital gains tax or final tax, and those which are exempt by law.
Talking about tax rate, regular corporate income tax. The income tax rate for the RCIT normal corporate income tax or normal income tax for all corporations is 30%, notwithstanding whether they are domestic or foreign. But with the new law, the rate will be lowered to 25%. Some domestic corporations may evenly qualify for lower tax rate of 20% if they meet the criteria related to their income and asset. These criteria are: the corporation net taxable income is not more than 5 million. Second, the corporation total assets are not more than 100 million, exclusive of land. In the case of corporation adopting the fiscal year counting period, the taxable income shall be computed without regard to specific date when specific sales, purchases, and other transactions occur. It means they don't have to worry about when specific sales and expenses. Instead, they divide their income and expenses evenly over each month fiscal year. The corporation income tax rate shall be applied on the amount computed by multiplying the number of months covered by the new tax rate within the fiscal year, multiply it by the taxable income for the period, divide it by 12 under Section 27A of the Tax Code as amended by the CREATE Law. Under the Revenue Regulation 5, 2011, implementing the said amendments, provided that the taxable year 2020, the following step will be taken. First, you need to divide the taxable income for the year by 12 months. Next, you multiply the number of months that apply to the old tax rate by monthly taxable income calculated in step 1. Then, you multiply that result by 30%. After that, you multiply the number of months that apply to the new tax rate by the monthly taxable income. And then, multiply that result by either 25% or 20%, depending on which rate is applicable. Finally, you add together the result from steps 1, 2, and 3 to get the total regular income tax. The same formula is used to reduce the minimum corporate income tax or MCIT from 2% to 1%. Now, let's illustrate the problem of corporate income tax year 2020. ABC Corporation, domestic retailer, has a taxable income of 690 million for the calendar year ended December 31, 2020. Its total assets are 180 million, exclusive of land and building, amounting to 50 million and 25 million respectively. How much is the income taxable due? Since the ABC Corporation does not qualify for the reduced rate of 20%, the applicable rate will be 25% beginning July 1, 2020. Accordingly, the computation of RCIT shall be as follows. In this table, net taxable income is 600 million. Divided by 12 months, result is taxable income per month is 57,500,000. Tax due. From January 1 to June 30, 2020, the taxable income per month is 57,500,000. Multiply it by 6, the total is 345 million. Multiply it by 30% equals 103,500,000. Use 30% because the effectivity of the CREATE law is July 1. That is why from July 1 to December 31, we use 25% of the new tax rate. The same method apply, 57,500,000, multiply it by 6, 345 million. Multiply it by 25% equals 86,250,000. Total regular corporate income tax due is 189,500,000.